Welcome to the Daily Update, where I'll go over the action in the market for Thursday, November 30th, and then we'll see how things look for Friday, December 1st, new month, coming into the last part of 2023. We're still looking pretty positive in the short, intermediate, and long term. We're still overextended to the upside. We've been pretty much chopping more or less sideways. We're seeing a little bit more intraday action. We would have ended up being down in Thursday's session, except for some buying coming in really late into the day, and that actually pushed us more positive. It was another day where the broad market outperformed the mega caps, and that's usually a good sign. That just means there's more broad participation. We're also potentially coming into some weak seasonality as we enter the first few days of December. And then once we get beyond that, historically, we typically have some good positive seasonality. So let's go back and talk about what happened. Right at the open, we had a very choppy open. Prices were just gyrating up and down. The bars, when I get to the chart, they're really quite wide. Prices, for the most part, moved lower and went below the unchanged level, but they didn't get all the way down to S1 at 43, 45, 36. As the day went on, prices chopped some more. We got back above the unchanged level, and we chopped higher to close above the daily pivot at 45.62. And really, for as crazy of a day as it was, we ended up closing pretty much near the daily high. So we were up 0.38% on above average volume. We are starting to see volume picking back up again. We are positive, mostly technically, and I'll back that up by going through the charts. We did get a big inflation report out on Thursday. We're going to get another influential report on Friday. The market is just wondering, okay, is the Fed going to raise rates? Are they going to keep them the same? Is there the possibility of them even lowering rates going into the future? Of course, we're keeping an eye on earnings as they are released, and then all of the geopolitical events. My understanding is that the ceasefire in Israel is now finished and fighting has resumed. That doesn't seem to be having a real impact on the futures prices before Friday's session, but that could always change. Some comments that we can make. Mega caps underperformed while the broad market outperformed. This is the same bullet point from yesterday's video. I didn't have to change it. We're seeing a little bit of profit taking. Some mutual funds are probably coming in, doing some capital distributions and squaring up things before the end of the year. If they owned any of the mega caps, they're probably locking in those profits. And that's why we're seeing those stocks show a little bit of weakness. Oil did close down at $75.96. One of the news items that came out is that several OPEC countries confirmed additional voluntary cuts that'll start January 1st and last through the end of March 2024. Usually we would see oil go up on this type of news. It really didn't have much of an impact, and oil ended up going down. Our short-term charts, looking extreme positive. We still have the short-term ADX, that's above 40. The 20-period exponential moving average, the Stochk RSI, and Williams percent R. Those are two of our touchier short-term indicators. They're still extreme positive. All of the stochastics charts, we have three on one chart there. The PMO oscillator is starting to get extreme positive. The RSI, based on 9 periods, it dropped off. Now it's back on. And the slope oscillator has actually turned negative, but it's still giving a very high reading and starting to come down. Intermediate term, our list is a little bit longer. We have the S&P 500 McClellan oscillator, the PMO studies, the rate of change going back 20 periods, the Sean trend meter, which is back on the list now, the RSI 14, also back on the list now, the TTM squeeze, which has been declining, but it's still extreme, the NASDAQ 100 bullish percent index, and then our 10-day average of the new highs and new lows for the S&P, that's still looking extreme. We're still dealing with this current scenario. There's just a little bit of modifications day in and day out, whether we're more positive or negative, that the Fed is going to go ahead and keep rates higher for longer. That's what they've already been doing. The speculation on the market's part is, okay, are they done raising rates? Can they look at actually cutting rates at some point in the future? That's the market gyrating things around. We're really not getting much of any evidence yet from the Fed that they're even considering rate cuts. That's the market doing that. If anything, we've heard some Fed speak this past week saying, well, if inflation starts to pick up, again, then we might have to go ahead and raise rates, keeping an eye on Israel, keeping an eye on oil, and keeping an eye on earnings as they are released. The dollar was down and interest rates were up, and we still have the 10 to the 2 and the 10 to the 3 month. Those yield curves remain inverted. Sentiment is positive since we closed it up a little bit. We ticked up to 66 where we had been at 64. We're not extreme yet, so we can tend to roll with this as sentiment is still staying positive and not necessarily extreme positive. When we get up around the 75 level, that's when we're starting to look more extreme. Our trend is still positive now. The ADX is strengthening. It's above its moving average. That one continues to look good, the intermediate term chart. It's the short-term chart that's starting to get extreme positive. Our bias is positive and our momentum is positive as well. Some economic reports that came out. This was kind of a big week. We had the important personal income report come out. It came in up 0.2% as expected and lower than the 0.4% we saw last time. Personal spending also came in as expected, up 0.2%. Last time it was up 0.7%. So we're seeing some cooling down here. PCE prices were unchanged. They expected them to be up 0.1%. Last time they were up 0.4%. The core, and this is what the Fed really looks at. It came in as expected, being up 0.2%. Last time it was up 0.3%. Weekly jobless claims. We did see a tick down last week, which was showing some strength. We're seeing them going back up slightly this week at 218,000, more than the 215,000 they had expected. Last week, it was at 211,000. The continuing claims are also starting to go back up a little bit at 1.927 million. Last week, they came in at 1.841 million. The Chicago PMI came in much stronger than expected. They thought it was going to come in at 45. It came in at 55.8. Last time, it came in at 44. Pending home sales were down 1.5%. That's less than the 2.3% they had expected to see for a decline. Last time, they were up 1%. Here are some charts to show you. Personal income and spending on a year-over-year basis. The blue line is spending, and that is declining. The yellow line is income, and that's also declining, but they're still above zero, so they are showing some growth. We look at the core inflation year over year, it's continuing to decline, and this is what the market likes, and this is what the Fed really keeps an eye on. On a month-over-month basis, personal spending did decline, even though it's still positive. The Chicago PMI really skyrocketed up well over 55, where we had been showing some improvement and then a little bit of weakness, and now we saw a real surge back in this latest reading. And the year-over-year pending home sales, they're still down on the year, but they are showing some improvement. The weekly jobless claims, after really coming down, they're coming back up now, but our 4-week moving average, that's the blue line, and that's what we follow the most. It is continuing to decline. The continuing claims, these continue to go up, and the moving average continues to go up as well. So we're seeing still things okay in the initial claims. This is where we're seeing the employment situation might be showing some signs of weakness. And we take it all together. The blue line is the continuing claims. The red line are the initial claims. And the black line is the last unemployment rate that we received. We closed at 4.35% for the 10-year yield. That's still above the 4.02%. We were inching down, but then interest rates went back up on Thursday. If we can get below this 4.02%, according to the RenMac research, this could start to help corporate profits. As long as we're above this 4.02% level, that could be biting into corporate profits. Our intraday chart, where we were really choppy. Look at the length of some of these 10-minute bars right here. We just chopped all over the place, but ended up drifting lower. We never made it down to S1 before we saw a bit of a bounce. It looked like, okay, we were turning more positive, and then boom, we came right back down and went negative. And then the last 20 minutes or so, that's when we saw a surge going into the close. We were able to get above the daily pivot and close pretty much at the high for the session. Here's the intraday chart, where we were looking more positive before the market opened. Then we saw some weakness after the market opened. And then here's the surge going into the close. And we're pretty much flat in the initial overnight session. We are still seeing where value, which is red, is outperforming growth. And that's a little bit of a concern. And we're also seeing that with our ratio for the S&P, where growth is underperforming value. Our end of day charts, growth and value were up for the large caps, but growth was up less. It was up more for the mid caps, and we're seeing a little bit of more strength with the mid caps right now. That's kind of a little place of hope currently. And we also saw small cap growth outperforming small cap value. But when we look at the end of day chart, this is not all that encouraging right now. We want to see this really turn and go up, and it was actually flat after it had been declining. Longer term, we're chopping sideways, but we continue to be in an uptrend. Looking at our trend, here's the ADX above its moving average. When this is moving up, that means the trend is getting stronger. The green line's on top, even though it's declining, but we still default to the positive trend because the green line is on top and the red line's on bottom. Short term, this is where we're a little concerned. This is the second day now that we've seen the ADX going above 40. Now, it could still go higher than this, but you see other times recently when we got to a really high reading, this did produce some kind of a short-term pullback, where when we saw this other reading, we ended up seeing an actual decline after that. So we might just see a slowdown, or we could actually end up seeing a reversal once this gets done playing out. But we're still positive. Even though the green line is declining, it's still well above the red line. Volume is starting to pick back up. We've had 2 days now of above average volume, so that is improving. Keeping an eye on sentiment, we're coming into the latter part of November, early part of December, where we see a little bit of historical choppiness with the VIX. If we can work through this time and then see the VIX go lower, that generally is positive for stocks. The Ulcer Index, though, continues to decline, suggesting that there's just not a lot of fear in the market. The VIX was pretty much flat on the line chart, and we were a little bit higher with the bar on the bar chart. Volatility is picking up a little bit. We're coming just up to the lower moving average here on the bar chart, where we actually decline on a closing basis, and we're still below the moving averages on the line chart. We are declining with the VIX to VVIX ratio. That is longer term positive. The VIX to the 3-month average of the VIX continues to decline. That's also longer term positive. The VIX to move ratio just shows that the volatility in stocks really continues to be under the volatility of bonds. And we finally have an updated chart here. Here's the equity put call ratio, which I was not able to update in yesterday's video. We really declined yesterday. We ticked back up a little bit in today's session. Now we're seeing a little bit of a switch again. We started to spike up here, and now we're coming back down. The fact that this is going lower is positive for the market, but we're wondering, is this a valid spike right here? Are we going to run into some trouble and end up going back higher, or is this going to continue to fall? Here's a longer term look at that same chart, where we can bounce up above this numerous times before we get a real strong signal to work from. The longer term equity put call ratio also is starting to turn back down again. This was a little indecisive, and I couldn't update this yesterday, but this is long-term positive. We ticked up just a little bit with this fear chart that we look at, but we have been declining overall. The other fear chart actually did decline, and this has been longer term in a declining mode. This is an area that we want to see some improvement in. This is the risk on to risk off ratio. It's just not breaking out yet. So this is not really giving us a lot of confidence. It's staying sideways for right now, but if you look at the longer term here, it has been declining. We did get the latest reading from the American Association of Individual Investors. They're just underneath the reading of getting extreme positive. When they get above this pink line, that's when they're getting a little too exuberant. And this is the point when we start looking to use this as a contrarian indicator. But for right now, we can just kind of go with this positive momentum. Our advanced decline line studies, we are seeing some improvement based on price and volume and above the moving averages. We're rolling over a bit with our 5-period moving average, even though the new highs did break out a little bit, seeing just a little bit of new lows being generated. But since we've been chopping around with the new highs, new lows, that's what's causing our 5-period to really start to get a little choppy. And we're pretty much flat to slightly declining with the 10-period. But when you look at just this overall, we're still hanging in there with a lot more new highs than new lows. The advanced decline ratio is improving. We're above 0 and advancing. That is positive. Accumulation distribution, after coming down a little bit, is now starting to go back up. This tries to measure what is the smart money doing, and right now they are buying. The chicken money flows, after giving us a really strong reading, has dropped back down a little bit. We did see some improvement on Thursday, but the red line is continuing to go down. We are showing some improvement with the NYSE cumulative advanced decline line. We were finally able to break above this upward sloping trend line. We're also showing some improvement now with our regular NYSE advanced decline line. This and other NYSE advanced decline line is also showing some improvement, and we're above both of the moving averages. We're also seeing more of a positive divergence here, where we're breaking out based on volume and we're not quite breaking out yet based on price. That's the way I interpret this. If we saw price breaking out and volume not breaking out, that would be a negative divergence. But we want to see volume leading price. And for the last couple of times we've been watching this chart over the last week or so, that's what we have been seeing, and I take that more as positive. Looking at our advanced decline line studies, we're showing some improvement with the NYSE common stock. We also turned up with the S&P, the mid caps, and the small caps were pretty much flat, but they're still above the moving average. Or looking at the daily chart, where we're still hanging in there okay. We're kind of having a real difficult time breaking above this previous high and closing above that level. And this is acting as overhead resistance right now. At some point, are we going to continue to go sideways and work off this overbought condition and then be able to break through that? Or are we going to eventually turn and start to come back down? On the bottom, we really picked up with volume in Thursday's session. Looking at our moving average study, we're still extreme with the 20. We're turning back up with the 50 and the 200. That is positive. The Stochk RSI continues to be extreme positive, and the Williams percent R is also extreme positive. We're turning back up, but we're still below the midpoint with the force index. However, in the bigger picture, this is still positive because we're above zero and green. But when we look at our stochastics charts in the short term, intermediate short term, and long short term, that's a further subdivision of the short term time horizon. We continue to be extreme positive, and we're flattening out here. We're back up in more of the +3 standard deviation now. This is still suggesting that we've gone up pretty far, pretty fast, but the fact that we've been able to hang on to these gains is positive. Some intermediate term charts. We're turning back up with the balance of power after it had spent a number of days coming back down once it gave us an extreme positive reading. We're still positive with the go, no-go system since it has the darker blue bars. We're still at the upper end of the highest high value. We're finally starting to see the blue line start to go up after we've been chopping sideways, and the midpoint continues to advance. So this is looking positive. The TTM squeeze, it's still positive, but it continues to decline, and it's turning to that darker shade of blue. Longer term, we did have an extreme reading back in April of 2022. That ended up marking a top. We're seeing a similar kind of reading right now, but since we've been watching this reading, the market has been chopping sideways. I would take that as more positive instead of a stop and reversal type of an approach. The rate of change going back 20 periods, yeah, it's declining, but we're still extreme positive. The ease of movement is flattening out after it had been declining and showing some improvement, and it's still positive. The Erin indicator was pretty much flat, but we're above zero with the oscillator. That's because the green line is on top. That's buyers. The red line is declining. That's sellers. The difference between the two is what the oscillator measures. We're starting to get extreme positive with the S&P McClellan oscillator, but this still could go higher. And when we look at the summation index based on price and volume, we continue to advance. That is intermediate term positive. We're also on a broader measurement looking positive with the NYSE summation index based on price and volume. The Swenlin trading oscillator, this was a bit of a warning sign. It's starting to flatten out based on price and volume. If this can turn and start to go up, that would be more positive confirmation. The PMO is starting to get really close to this red line here. This just means that we've gone up pretty far, pretty fast, and this indicator could be getting to an overbought condition, or at least an extreme positive condition. But for right now, it's still positive. And when we break it down based on price and volume, they are positive as well. We're no longer extreme here with the PMOs that are rising. We're coming right back up to this 80 level. So another tick higher, and that's going to be extreme. We're still extreme with the buy signals, but rolling over, we continue to be positive with the PMOs above zero. We continue to be neutral with the Elder's Impulse system for the S&P. However, with the parabolic SAR, that's stop and reversal. When the dots are underneath, that is positive. The slope oscillator, this is really starting to come down and it's below its moving average after giving us a pretty extreme positive reading. The MACD is starting to roll over, but it's still positive. When we look at all of our oscillators, here's the slope oscillator, which we just looked at. The TSI is starting to get extreme. The MACD is rolling over, a little bit of rollover with the PMO and the PPO, where the TRIX is starting to get extreme and the KST is already extreme. So this is kind of a warning sign right now. The Sean trend meter, after not being extreme positive, is now crossed back above the red line. It's now extreme positive. We're still above all of the moving averages in our moving average tree. This is a more positive sign now. We still continue to see the bullish percent index continue to advance, and it's not extreme right now. And this isn't like some of the other indicators that we use that they use previous prices to calculate. This is just where are things at right now, and then it plots whatever's happening. The NYSE bullish percent index continues to show some improvement. We're above 50 and advancing. That's broader. The broad market is showing some improvement. And we're still hanging in there okay with the NASDAQ 100 bullish percent index, but we're getting to a pretty high reading. The Chaikin oscillator is finally turning back up. It had been declining, but it's still above zero. That's positive. The money flow continues to decline. It's still positive because it's above 50, but it is declining. The ultimate oscillator is turning back up and is above 50. The vortex is starting to turn up with the green line. That's turning back more positive after it had become pretty extreme. The RSI 9 is just barely looking extreme positive, where the RSI, this should be the RSI 14, is barely extreme positive, where the RSI 9 is still extreme positive. On balance volume continues to be positive. It's above an advancing moving average. We're showing some improvement with the 200-day moving average study, as well as the 50-period moving average study for those stocks inside of the S&P 500. The Copic curve, though, has now generated a sell signal. And longer term, we had come up to a pretty high reading, where other times this was rather extreme. It started to turn back down. This is a bit of a warning sign. I don't have any Fibonacci charts to show you, just keeping an eye on this trend line. We were able to get above this previous high that was set on July 31st. Can we stay above that? Are we going to be able to break to the upside? If we fall, will this area now offer support? Our different charts, we're still looking good with the trend. The Heiken Ashi, even though this is looking more like a doji candle, just like it was after Wednesday's session, it's still positive when you look at all of the candles together. The Kegi is positive, but now we're seeing the black line starting to come down. So it's positive with a bit of a negative slant. But when we look at the Renko, we're still positive, and the three-line break continues to be positive. We're also keeping an eye on this. This could be longer-term negative. The Zohorchak, it's coming down and giving us a -6. If we fall all the way to a -10, that would be a full-blown sell signal. If we see a bounce from here, we'll be watching this chart to see if it shows some improvement. Looking at some other indexes, the equal weight index actually outperformed the S&P, but it's still been underperforming in the bigger picture. And we really saw a decline with our ratio between the S&P and the equal weight S&P. And that's just suggesting not that things are turning negative. This just means that the broad market is outperforming the big mega caps for right now. The Dow really shot up, where transports were up just a little bit and utilities were up even just a little bit as well. And the transports, this is another area of concern. They continue to underperform the Dow. When this ratio is going up, that means the Dow is outperforming the transports. We want to see this going down. It's going up. And when we want to see this going up, and it did tick up a little bit with this ratio, but we really want to see this take off and move to the upside. When we look at the transports to S&P 500 ratio, not just a day or two of looking better, we want to see the trend actually turn. The Dow really shot up. It was up almost 1.5%, and this is a pretty healthy looking chart. Apparently there was an earnings report. I think it was Salesforce came out, and they just blew everybody out of the water, and that ended up giving the Dow a real push higher. That's why it's only 30 stocks. That's why I prefer the S&P 500. You don't have as much of an influence except when you're using just 30 stocks. One stock can just make or break the whole index. The diamonds have finally switched over to positive for the Elder's Impulse system. The NASDAQ, we started to drop down below this pivot level, but we were able to close right on it. And we're still above the 61.8% retracement level. If we continue to fall, we'll be watching this level as support. As long as we can stay above this, we're more or less in no man's land. And the NASDAQ 100 also dropped down below this pivot, but was able to close back above it. We continue to be neutral for the QQQs when we use the Elder's Impulse system. And we're seeing a little bit of weakness here with the PPO. This is a momentum oscillator for the NASDAQ 100. It is starting to roll over. It's still positive, but it has been showing some weakness. Some of this, as I keep saying, could be how the indicator is actually calculated. As we've been going up, the lower numbers are dropping off the calculation, and now it's higher numbers that are being used in the calculation, and that's causing this line to roll over, which a lot of times ends up being a self-fulfilling prophecy. The small caps still continue to pretty much chop sideways. They cannot get above their 200-day simple moving average. And I said these were the mid caps yesterday, and I made a mistake. When we look at the Russell 2000 small caps, we're still above 50 and advancing with the RSI. We continue to be in a longer-term downtrend. We were able to close just a little bit above the 200-day moving average for the Russell. So that could be positive, and the momentum is still positive, even though the MACD is showing some weakness. We continue to be neutral for the small caps when we look at the Elder's Impulse system. The mid caps, did I say mid caps? Small caps? Okay. Look at the chart names instead of what I'm saying. We continue to be above the 200-day moving average for the mid caps, and we pretty much have been moving sideways. And the Elder Impulse system is picking that up with blue bars. The financial sector, it was up well over 1% again, showing a little bit of love here, starting to go back up after generating a recent golden cross. The micro caps were also up almost 1% and continue to be above 100. The FANG index was down 0.25% and has been chopping sideways. However, this nice move up looks pretty healthy. We're still above the 50 and 200-day moving averages, and we're in a longer-term uptrend. And we're still having some difficulty with this previous all-time high. We get above it for a while, then we come back and drop down below that. The dollar was down a little bit in Thursday's session, but it's still in a longer-term uptrend. Keeping an eye on bonds, we were up with the 10-year yield. We were down with the 10-year based on price. This is still acting weird, and I'm not quite sure what's causing all of this. We are at a plus 0.11 now when we take the 1-month yield and subtract the 3-month yield. So if you tied your money up for 1 month, you would get a higher return than if you tied your money up for 90 days. Doesn't make a lot of sense. We usually see a negative result with this chart. There usually is some kind of an anomaly going on when we get a positive answer here. An update of some of our growth to value ratios. We're actually coming down a little bit with the Qs to the S&P. We declined with discretionary to the S&P. We also declined with the large cap growth compared to large cap value. We're coming down just a little bit with the large caps, pretty much flat with the mid caps, and we're declining with the small cap ratio. We're still extreme positive with the 10-day average of the S&P 500 highs minus the lows. We've been up here now for a few days. That could suggest good momentum, but the market's continuing to more or less go sideways. We're still positive here. When we look at the 5-period moving average of the highs minus the lows across the Amex, NASDAQ, and NYSE, the longer we can stay above zero, the more improvement we'll see in the broad market. We're still looking more positive with our 50-day exponential moving average of the new highs minus the new lows. Because the black line is still above zero, that's pulling the moving average, which is the red line, back above zero even further. The 2-year treasury yield, have we topped out and are starting to decline? That's not giving an awful lot of support to the S&P. Other times when this happened, that can give short to intermediate term support to the S&P itself. And the Staples to S&P 500 ratio, it ticked down just a little bit. We have been declining when you look in the little bigger picture. And we're no longer extreme positive with the 19-day exponential moving average of the advanced decline ratio. After giving us an extreme reading based on price, we're continuing to decline. We're also declining just a little bit based on volume, even though this is an improvement over Wednesday's session. And here's Tom Bowley's research. I don't have his chart yet for the month of December. I just kind of have to wait until that comes in the email. So what's our outlook for Friday? Still dealing with earnings, still dealing with geopolitical events. The technicals are positive. We continue to be overbought. I haven't changed this note on this slide for over a week now. We are wondering if there's some kind of weakness developing. We're not really seeing that yet, but we're not seeing really any strength right now either. We will get the S&P Global U.S. Manufacturing PMI. That'll be coming out, as well as ISM Manufacturing. That'll be the big one for Friday's session. Construction spending will also be coming out, and then we're keeping an eye on the geopolitical events. So we will complete the economic calendar. In the video that I'll make for Monday, I will have an updated calendar. Now, this is something that I usually go through at the beginning of every month, even though I forgot at the beginning of November. This is the Stock Traders Almanac yearly statistics. And I don't show these because I just be repeating myself. These apply to the whole year. And when I say in the longer term videos, like the weekly videos, and I say the long-term setups and seasonality, those are still in the background. This is what I'm talking about right here. And this goes back to almost a year ago. The January barometer states that the year follows January 83.33% of the time, going back to 1950. Then we had almost a year ago what's called the trifecta. First, the Santa Claus rally. It was positive, so that gave us a score of 1. The first 5 trading days of January, they were positive. That gave us a score of 2. Then we take January altogether. That was positive, so that gave us a score of 3. And that applies to the whole year. When we do get this trifecta, the next 11 months, because usually this is done at the end of January, so you can only go 11 months forward from there, we are up 87.1% of the time with an average gain of 12.3%. When you take the whole year together, we're up 90.3% of the time with an average gain of 17.5% going back to 1950. This is the positive seasonality and background that I've been referring to. The markets also like that we're split between Republican and Democrat in Congress, and because they can't pass a lot of rules that stops the market from doing what it wants to do. We also have to keep in mind on executive orders, because that seems to be where most legislation is coming from these days. Then just looking at December 1st, we're neutral to negative with the Dow. We're negative with the S&P. We're neutral to negative with the NASDAQ. December ends up being the 3rd best month of the year. We are up 75% of the time in December. We're down 25% of the time. So we have some real positive seasonality here. I'll go through the options expiration as we get closer. So here is the new calendar. We look at the green dashed line for what's happening with the S&P, and that's pretty much flat. Then I've shifted this over a little bit. We're coming into the latter part of November, early part of December. We tend to see maybe a little bit of a dip here when the current president is running for re-election. We also may see a little bit of sideways action that we've been seeing already before we see a little bit of weakness, according to this chart. Where this chart, we tend to see some more strength, a little bit of choppiness before we end up finishing the year stronger. And when we compare election years with non-election years, we're also coming into a time where we could see some positive seasonality, but then short bouts of weakness as well. Carson, this is still the earlier part of December where we are in this, at least according to their measurements, we could be seeing some historical weakness. And then this is another new chart that I added where right at the beginning of December, we tend to see a bounce up. Then as we get a little further into December, that's when we see some weakness before going into the end of the year. And then here's the Stock Traders Almanac for the NASDAQ, where this tends to look more or less positive. The S&P also tends to look more positive. So we've got the whole gambit here. But that's what I like to do. I don't use these to make decisions. I use them as guides, and I just kind of take them all together. But then it's our charts that ultimately tell us what's happening. We're not going with the down scenario for right now, even though we are overbought. There could be some weakness developing, but we're not really seeing that happening yet on our charts as far as price action. So we tend to lean more towards the positive side, even though we are overbought, and there could be some weakness developing. We're not going with the sideways trend for right now because both the short and intermediate term indicators are telling us that we are in a trending environment. So the warning signs, the risk on posture, that's a little bit of a concern. That's the risk on, risk off. It's really not doing all that much right now. The copy curve has generated a sell signal. We're still dealing with downtrends with the Russell small caps and mid caps. But on the positive side, we still have the daily special K chart, which is positive, and I haven't been showing that because it doesn't change all that often. The equity put call ratio is now turning and going back down, where in yesterday's video, I didn't know what to tell you then, where the longer term equity put call ratio is also turning back down. That's positive. On a momentum basis, we are still positive, but we have a few of our S&P 500 oscillators, like the slope oscillator. It's starting to roll over and actually crossing below its moving average. We have some other indicators that are looking extreme positive. We are seeing some weakness with the NASDAQ 100, but it has not crossed over negative yet. The parabolic SAR chart and the vortex charts continue to be positive. The bullish percent index is also still positive, and small and mid-cap growth continues to be positive, even though it's chopping sideways. The financial sector's been seeing some strength lately and has generated a recent golden cross. And our longer-term 50-period moving average study based on new highs and new lows, that continues to be positive and is crossing back a little above zero. So our conclusion, same conclusion that I've had for a week now. We are positive. We are overbought. We are overextended, whatever you want to call it. We're waiting to see if weakness is going to develop because we're not really seeing any strength right now. And we can say that same thing for the short and intermediate term. We're still positive in the long term because we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.